Okay, let's go.
Let's be real. You can try to memorize a million chart patterns, but what if I told you that every single line, every peak, and every valley on a chart is actually telling a story, a human story? We're going to learn how to read that story, the raw language of the market, which is driven by two of the most powerful forces out there, fear and greed.
Does this look familiar? You've probably spent hours, right, memorizing all these patterns from a book. You got your double tops, your head and shoulders, the whole shebang. But then you look at a live chart and it's just a mess. Nothing ever looks quite as clean as it does in the textbook. And that's super frustrating because just memorizing pictures isn't the same as actually understanding what's going on.
But what if there was a simple, logical reason these patterns work in the first place? A psychological story that, once you get it, makes everything else just click. You know, it's like the difference between memorizing a few phrases in a foreign language and actually understanding the grammar. Once you know the grammar, you can say anything you want. So that's exactly what we're going to do. We're not just going to look at squiggly lines on a screen. We're going to pull back the curtain and uncover the human story that's driving all of it. We're going to see the fear, the greed, and the collective beliefs that are pushing that price up and down with every single tick.
Okay, first things first. We need to completely change how we look at a price chart. It's not just a financial graph. Think of it more like a battlefield. It's a real-time story about a war between two incredibly powerful emotions, fear and greed, playing out in the minds of thousands of people all at once.
And this quote it nails it. Price action isn't some complicated abstract theory. Every single candlestick, every little wick you see on that chart, it's a footprint. It's the sum of all the decisions made by thousands of traders just like you, all reacting to the price in real time. It's basically a live feed of human psychology.
All right, so to read this story, we've got to learn its basic grammar. And rule number one is this: the market almost never moves in a straight line. It moves in one of three ways, and each one has its own unique psychological fingerprint.
So, over on the left, we have the uptrend. Just look at the structure. You see higher highs and higher lows. This is what optimism looks like on a chart. Buyers are feeling confident, they're pushing the price to new heights, and they're eagerly buying up any little dip along the way. Now, on the right is the complete opposite, the downtrend. Lower lows and lower highs. This shows that the sellers are totally in control. Pessimism is the name of the game, and sellers are just jumping on any attempt the price makes to rally.
And then there's this, the sideways trend. This is basically the market just holding its breath. It's a tug of war where the buyers and sellers are in a complete deadlock. Neither side can get the upper hand. But don't let that quietness fool you. This is like a coiled spring, just building up energy for its next big, explosive move.
Yeah, inside these trends, you'll start to notice something really fascinating. These invisible walls. Key price levels where the market just seems to hit a floor or a ceiling over and over again. Now, these aren't magic lines. They're psychological barriers built from the collective memory of every single trader watching. We call them support and resistance. Let's make this really simple. Just picture a stock that for months has been totally stuck in a channel. It never seems to drop below 10 rupees, and it can never seem to break above 20. After a while, a shared belief starts to form in the market around these two numbers. And here's where it gets kind of cool. That belief, it becomes a self-fulfilling prophecy. Check out this cycle. When the price gets near 10 rupees, all the traders who remember that as a bargain price start buying, and that demand pushes the price up. And then, as it gets close to 20 rupees, all the people who think it's expensive start selling, pushing it right back down. The cycle just repeats and reinforces itself, making those invisible walls stronger and stronger. So, this is the key takeaway right here. Support and resistance levels aren't a law of physics, they're a law of psychology. Plain and simple. They only work because everyone believes they will work, and that belief creates these really predictable zones of buying and selling pressure. It's a wild example of a collective belief literally shaping reality. But what happens when the story changes? What happens when a belief that seemed totally set in stone is suddenly just shattered? Well, that's where the biggest, most powerful moves in the market come from. This is the moment when the price breaks all the rules. So let's go back to our 10 to 20 rupee stock. Imagine it's a potato company. For months, the entire market agreed that 20 rupees was expensive for their stock. Then, one day, boom, news breaks of a massive, unexpected potato shortage. All of a sudden, the entire story changes. 20 rupees isn't expensive anymore. No way. It's a bargain.
The old belief system just got completely destroyed overnight.
And that is a breakout. It's not just a move on a chart. It's a psychological earthquake. The old agreement that 20 rupees was the ceiling is shattered, and a brand new one is being formed in this massive wave of buying pressure that just completely overwhelms the sellers, who are trying so desperately to defend that wall.
And this leads us to the most important part of this whole thing. What's the secret logic behind a breakout's explosive power? Why do they so often move so far, so fast? Well, it's not just about what you see on the surface. There's a hidden engine at work here. So let's get right to it. What is this hidden engine? Where in the world does all of this sudden explosive buying pressure come from? The initial move, sure, that comes from new, enthusiastic buyers jumping in. But the explosive follow-through, the thing that gives it that incredible power, that comes from a secondary, almost mechanical source that most people completely overlook. A hidden source of pure rocket fuel. And here's the secret. It's the stop-loss order. Just think about all the traders who bet against the stock right at that 20 rupee resistance level, the short sellers. To protect themselves from a huge loss, they all placed stop-loss orders just above it, maybe at 22 rupees. Now this is the most critical detail of this entire explainer. To close out a short position, to get out of their losing bet, they are forced to buy the stock back. So their stop-loss isn't a sell order. It's a preloaded, automatic buy order just sitting there, waiting to be triggered.
Okay, now just watch the dominoes fall. The first wave of real buying pushes the price to 22 rupees. Click. That triggers the first set of stop-loss orders from the short sellers. Those automatic buy orders create even more demand, which pushes the price even higher. Click, click. That triggers the next wave of stop-losses. It's a chain reaction, a cascade of forced buying from panicked sellers, and it adds pure rocket fuel to a fire that's already burning bright. So when you see a huge breakout on a chart, you're not seeing something random or chaotic, you're actually watching a beautifully logical chain reaction unfold. It's the psychology of the buyer's greed colliding with the psychology of the seller's fear, and it's all amplified by the cold, hard mechanics of automated orders. It is, quite literally, the perfect storm.
So, I'll just leave you with this one question. Now that you understand the human story, the shared beliefs, the fears, and the mechanical traps that create all these patterns, will you ever be able to look at a simple chart and see just a bunch of random lines ever again?